So credit for the elderly or the disabled. Obviously, for low-income individuals, you have to be 65 or older, or have retired on permanent and total disability, and be receiving taxable disability income in order to receive the credit. Taxable disability income it's kind of hard to receive taxable disability income if it's permanent disability, because most of the disability income at that point is not taxable. But so this credit is really rarely used, at least in my experience. Maybe it's used in some other practices, but certain AGI and non-taxable Social Security income limits apply. So remember, the non-taxable part of Social Security, we do that whole calculation to figure out what the taxable part is. Everything else, the non-taxable part, is going to go into this calculation here. The maximum allowable credit is 15% of the taxpayer's base amount. So we have to do a couple of calculations here. We have to determine first what the base amount is, and then take 15% of that. All right, base amount, $5,000 for single individuals or joint returns when only one spouse qualifies, $7,500 for joint returns when both spouses qualify, $3,750 for a married person filing a separate return. So here's our base amount. Second part here is we have to reduce the base amount by the amount of non-taxable Social Security and 1/2 of the amount of AGI that is over $7,500 for single returns, $10,000 for joint returns, $5,000 for married filing separately. All right, so let's look at this example. We've got Lou and Greta. They file a joint return. Lou is 66, Greta is 63. Greta doesn't qualify because she's not 65. And it doesn't say anything about her being disabled. So, base amount, single individuals, joint returns when only one spouse qualifies. So we're going to start with that $5,000 and then make an adjustment. They have AGI of $11,500. They received $1,000 of non-taxable Social Security benefits. All right, so let's look at our instructions here. So we start with a base amount of $5,000. But we've got to adjust it. So we have to subtract the amount of non-taxable Social Security, $1,000, which this is a really, unless they really didn't receive much Social Security benefits, that's not a very realistic number, but non-taxable Social Security benefits, and 1/2 of the amount of AGI that is over $7,500, $10,000, or $5,000. All right, so the amount of AGI that's over that, $11,500 minus $10,000, $1,500 divided by 2. Okay, we gotta subtract that. 1/2 AGI over 10K. All right, so 3,250. $15% of the taxpayer's base amount. And we're going to take 15% of that, which I will use their calculation. That's our credit, $488. All right. The reason this credit is hardly ever used is because people who are low income enough to get it usually have a lot of non-taxable Social Security income. Maybe 100% of their Social Security income is non-taxable, and they've got to subtract it from this piddly little amount up here, right? So that alone would bring them down to 0. So like if Lou and Greta had non-taxable Social Security income of $7,500, that automatically brings them down to 0. They get no credit. right? And that's not out of the ordinary. That would mean that they had, you know, 7,500. I mean, who knows? That could be all their Social Security income, but in practice, it really doesn't use. You really don't use this very often, and they mention that here. Because if some Social Security benefits are taxable, the taxpayer already would have exceeded the AGI limits. Here. All right. So here, Vincent and Maria, age 70 and 67, so they both would qualify, they're both over 65. File a joint return, they have AGI of 21,000, they received 1,000 in non-taxable Social Security benefits. All right, so their base amount up here, because they both qualify, is 7,500, and then we would subtract their non-taxable Social Security benefits, and then 1/2 of AGI over $10,000. So what was this? Where are they? So 21,000 minus 10,000, 11,000, half of that. So 5,500. Well, so 1,000 times 15%. $150. Okay, questions about this? Nope.